How is everybody doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about something called Enterprise Risk Management, or ERM. Now, obviously, most people understand that managing risk is one of the most important aspects to successfully running any bank or financial institution out there. There's a myriad of risks that senior management of any bank has to be aware of on a daily basis. You have operational risk, you have credit risk, cultural risk, you have reputational risk. There's all kinds of risks out there. They have liquidity risk, capital risk. There's tons of risks all over the place. Stakeholder risk, what happens if you anger one of your stakeholders, your investors, your employees, the community. So there's lots of risk out there. And one of the ways that banks can use, or one of the tools in their toolbox, if you will, is called enterprise risk management. And I saw these couple of articles here in Bank Director, which basically addressed this very issue. And I thought it was a great time to kind of bring those in and run through them real quick and give everybody a little bit more flavor as to what exactly is ERM. It's a concept that has been widely talked about and used for a long time, and basically not just banks, but in corporate America in general. So this is a two-part series, and it's basically called Enterprise Risk Management is about managing risk, not avoiding it, parts 1 and 2. And we're going to go over the first part here real quick. And so this basically says, with continued industry instability, banks should take on a broad and holistic approach to risk management. Now, how should banks and boards think about risk in an organization? Over the past 2 years, dramatic bank failures, declining profit margins, and increased credit concerns have heightened the industry's collective anxiety about risk. To clarify that risk and underlying exposures, many have searched for short-term or isolated answers, viewing risk in the moment rather than proactively and broadly across their individual institutions and the industry. Many have sought direction from regulators, asking regulatory officials to clarify their primary concerns and provide direction on how to address specific risks. However, the regulators have resisted calls to address any singular risk and have instead suggested that risk should be viewed broadly and holistically, while bankers should tackle whatever risk is presented. Newsflash to everybody, regulators are never going to answer those questions. They're always going to give you some vague answer like this. You should view risk broadly and holistically, and think and just contemplate man's meaning of the universe. That's always how it's going to be. So banks really, like I said, banks, credit unions, whatever. I mean, you're really in a certain respect left to your own devices to analyze this risk. But thankfully, we have something called enterprise risk management. Now, what is enterprise risk management, or ERM? There is no single definition or that objectively defines ERM. However, the most widely referenced governing body for risk management in the United States, the Committee of Sponsoring Organizations, or COSO, defines ERM as a process affected by an entity's board of directors, management, and other personnel applied in strategy settings and across the enterprise. It is designed to identify structural risk positions that may affect the entity under certain adverse impact scenarios and manage risk to be within its risk appetite, to provide reasonable assurance regarding the achievement of the entity's objectives. That's a mouthful, as it says here. An easier interpretation might be the ERM is a process that manages enterprise risk so that ongoing decisions are consistent with the company's risk appetite and stated performance goals. Taking risk is internal to the pursuit of value, so the process of ERM is not meant to eliminate risk or even to minimize it. Instead, the goal of ERM is to manage risk exposures across all parts of the organization so that at any given time, the organization can incur just enough of the right kinds of risks, no more, no less, to effectively pursue its strategic goals. ERM is about taking risk, not avoiding risk. It is also important to note that ERM is not simply a function or a department. It involves the culture, capabilities, and practices that an organization integrates with strategic setting, with the purpose of creating, preserving, and realizing value. As Alan Greenspan famously noted, indeed, better risk management may be the only truly necessary element of success in banking. So, How do I create an effective ERM system in my organization? So, well, we have to, we have established that risk management needs to be proactive and holistic, and that ERM is a process that integrates with strategy setting and value creation. But how do you functionally build an effective ERM process in a community or regional banking organization? And that will be the subject of part two, which we're going to go to right now. So as we jump on here, so basically, the meaning here is like I said, we jumped off there with how do I effectively put ERM into the system? Well, here it says, what does it mean then to identify, measure, monitor, and control risk? So, and this is gets into like the implementation thing. So we have these four different categories here: to identify, measure, monitor, and control. So, and this goes on to say, so in all supervisory guidance related to risk management, you will hear identify, measure, monitor, and control. Regulators want to know if your organization's ERM process identifies, measures, monitors, and controls a full spectrum of risks. While regulators largely focus on an organization's viability risk, these same considerations apply to strategic and performance risk. So let's look at identify risk. This step involves considering all potential risks that may impact an organization. In banking, there are frameworks and guidance to establish primary risk categories. In the Fed guidance we outlined, those principal risks include 6 categories. So number 1, credit risk, or risk arising from a borrower or counterparty failing to perform an obligation. Number 2, market risk, or risk resulting from adverse movements in market rates or prices, including interest rates. Number 3, liquidity risk, or risk that a financial organization will be unable to meet its obligations due to an inability to liquidate assets or obtain adequate funding. Number 4, operational risk, or risk resulting from inadequate or failed internal processes, people and systems, or from external events. Number 5, compliance risk, or risk of regulatory sanctions, fines, penalties, or losses resulting from failure to comply with laws, rules, regulations, or other supervisory requirements. And then finally, number 6 is legal risk, or risk that actions against the institution could result in unenforceable contracts, lawsuits, legal sanctions, or adverse judgment that could disrupt an organization's operations. Now, there are some other risks there, but I think that's top 6, credit risk, market risk, liquidity risk, operational risk, compliance risk, and legal risk. I think that really does a great job of really covering mainly the 6 main risks that you really need to address and make sure that you've got covered there on it, kind of day in, day out, month in, month out, year in, year out basis. So, and then it goes on to measure risk. So once you identify risks that could impact your organization, you must develop criteria to empirically measure those risks. So ERM systems have 2 primary ways to measure risk: quantitatively and qualitatively. So quantitative measure consists of numerical positions that can be objectively measured through objective data. Capital ratios, loan performance, and compliance statistics are quantitative indicators that can be used to objectively measure the identified risks. On the qualitative measures, they are based on subjective observations that relate to policies, systems and processes, management performance, and control structures. Collectively, they can potentially mitigate quantitative positions. Administrative controls and management process to mitigate risk may offset a higher risk asset structure. So again, you have quantitative and qualitative, very, very different measures. Quantitative, I think, in banks is it's very easy in a certain regard, very straightforward. I mean, you're just going to measure all the, how's your portfolio? What does your capital levels look like? What does your liquidity look like? What are the investments that have been made by the bank on the balance sheet? What's the access do you have to other types of funding, whether it be like Federal Home Loan Bank or a discount window or whatever the case may be? Qualitative, as it states, is much more subjective. So that can be a little bit harder to kind of quantify that, so to speak. And then it gets into the last 2 things, which are monitor risk and control risk. So monitor risk. Monitoring risk involves the information systems and processes used to evaluate quantitative and qualitative measures. Does the board have access to the sufficient information to understand how the measured risk positions relate to one another and change over time? Does information include reporting structures that let the board determine if management is complying with policies and the board's prescribed risk appetite. Without systems to effectively monitor risk, identify and measured risk positions are incapable of effectively informing an organization's actions. And then finally, control risk. While controlling risk may involve taking action to reduce the likelihood of adverse events, it also informs acceptable risk taking and provides operating management with the framework to take risk effectively. So risk is integral to pursuing value. The ERM process is not meant to minimize or eliminate risk. The goal is to manage exposures across an organization so that at any given time, the organization can incur enough of the right kinds of risk to effectively pursue its strategic goals. ERM is about effectively taking risk, not avoiding it. And if you devote the time and energy to meet ERM's basic guidelines and principles, statistics show that your company can perform more effectively and profitably. So there you have it. There are the two articles there from Bank Director, and I would say yes to all of this. I think this is great stuff. I think ERM is a great thing to study and really look at all the attributes of it. But ERM is one of those things, like we said at the beginning, we were looking at kind of the definition of what ERM is. It's not something, there's not a absolute kind of definition for it. It's basically something that you ingrain in your culture. And it goes from top down. It goes from the board down to management, down to the employees. And it's about setting a risk appetite within the culture of the company and then identifying, measuring, and monitoring and controlling those risks. Again, there's always going to be risk. You can never fully eliminate risks 100%. That is impossible. You cannot do it because some risks are within your control and some risks are completely outside of your control. You have market risks. What the Fed does. Your bank that you may be working at has no control over what the Fed does with interest rates. They have no control on what the government does with fiscal policy. Like those are things that are completely out of your control. But what you can control is what is going on within your organization. What's your risk appetite? What are you willing to do and not willing to do? Like these are all things, and this all gets into the deeper things of the company's culture and strategic planning and the people that you have in place now. And then the last thing I'll say on this is that normally, depending on the size of your organization, you might have a chief risk officer who would most likely implement the ERM system, kind of throughout the bank. But even if you don't have a chief risk officer, a number of the executives can work on there should be no reason why, you can't implement an ERM system within your bank. It's not about a cost per se. It's not like a system that you have to buy. It's more like your strategic thinking and your strategy within the bank and how you incorporate that within your culture and you break it down throughout the departments of the bank and just how you're looking and managing all the different risk aspects of the bank. So like I said, I hope people find this really interesting. I think there are aspects of enterprise risk management that I will delve into in future episodes as they present themselves. And I think it's also important that, when we get into different topics, when we talk about strategic planning, when we talk about, managing the bank's credit portfolio, when we talk about managing the bank's investments on the balance sheet, like, buying, bonds and treasuries and all this kind of stuff. As we get into all these different topics, kind of ERM will always, in a certain respect, be a part of that because it all gets back to risk management and risk mitigation at the end of the day. So, but anyway, I hope you like this episode. I hope maybe you find this interesting. But I would end with this. If you liked the episode today, please make sure to like, share, and subscribe as it helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And make sure to check out some of the other content on the channel. And I will be back to everybody again real soon. Thanks a lot.